there might be like one trader who, like wins a lot of money, but it will not bankrupt the whole system because mathematically it's kind of like a pool. So if we start like when ETH is like $100, suppose that we create this AAM, and then so there are like 10 traders coming in, and then each one takes a long position. Because of this is HYK, so everyone takes their own position, the price actually goes up. So you can see that if there are 10 traders, so the price goes up like 10 times.
Hey guys, welcome to the CoinGecko podcast. My name is Bobby. I'm the co-founder and COO at CoinGecko. For today's episode, we have Yenwen Feng, co-founder at Perpetual Protocol. If you're watching this on YouTube, we at CoinGecko really appreciate if you hit the subscribe button below. And yeah, we're happy to have you on the show, Yenwen.
Yeah, thanks for having me. Yeah, it's a great honor to be on the show.
Yeah, I think to start things off, right, Yenwen, maybe can you give us a simple explanation of what Perpetual Protocol does?
Sure, of course. So we at Perpetual Protocol, we are building a decentralized perpetual contract protocol, which means that you can check perpetual swap on top of Perpetual Protocol. You can think this is kind of a Uniswap meets BitMax. So BitMax is kind of invented by, Perpetual contract is invented by BitMax, and we kind of add an AAM on top of that. So it kind of like have all the good characteristics of AAM, like Uniswap. You can trade anytime you want. You can ignore the slippage. You kind of like get, there are liquidity there that you are sure that the liquidity won't get pulled away by market maker. So I think that's generally what the Perpetual Protocol is.
Yeah. So TLDR is Perpetual Protocol, in my understanding, is like a decentralized version of BitMax. Which has the most popular contract in crypto called the Perpetual Swap contract, right? So before we get deeper into this decentralized versus centralized conversation, like share with us, what do you think are the main benefits of using Perpetual Swap contract, of trading this Perpetual Swap contract, compared to just trading the margin trading on one of the exchanges? Like you can kind of margin trade 5x, for example, but why would you want to use Perpetual Swap, for example?
Yeah, that's a good question. So actually, I think it's if we go back and then look at also BMax, actually, they kind of like have this idea, in the early day of crypto. So why they have this idea like to create a perpetual contract is that at that time there is no stablecoin. They are only like so they're only like Bitcoin and a few like other coin. So if they want to trade other asset, perpetual contract. The good thing about perpetual contract is that you don't really need underlying. So you don't really need a lot of like margin trading. If you want to have margin trading, the first thing is that you must have like ETH or other tokens on your platform first. So you can kind of like lend it out to the traders, and then they can do the margin trading. But perpetual contract, you don't. So people kind of like betting against each other, just like futures. So I think that's actually the main reason that you don't really need an underlying asset. So it's more flexible. So like we can also do like asset that doesn't have on-chain, property. So like like oil futures or something like that. So you don't really need that token. So I think that's the benefit. And the second thing definitely is the capital efficiency, because you don't really need underlying tokens. So there is no cap on the on the open interest. So you can have as many contracts as you want. So I think that's also increase the capital efficiency. So I think that's the two main reasons.
Cool. You guys just launched your version 2 of Perpetual Protocol. Congratulations on that, first of all.
Thanks.
So I guess my question would be, what would be the main difference between Perpetual Protocol version 1 and Perpetual Protocol version 2?
Yeah. So if you look at like Perpetual Protocol V1, so what we have on V1 is that we actually have kind of like two components. So one thing is that we have this ability to take in collateral like USDC and then mint virtual token. So we can mint virtual ETH, virtual USDC, and then the second part is that we have this SYK model just like Uni V2. So I mean, traders can place virtual ETH on top of the V2. So we use the SYK model as the kind of like a trading engine, I mean pricing engine for the whole, I mean perpetual contract pricing. So that's how what we did in V1. So that's how the system works. And in V2, we actually taking the SYK out. So the SYK, we're not using the SYK model anymore. And then we connect with Uniswap V3. So Uniswap V3, they launched like in May. That they have this new, really exciting, that a little bit complex model that that the liquidity provider can actually provide liquidity within a certain range, so they can kind of express themselves, their view to the market using that model. So we plug the Uni V3 in, and then the whole system actually can become more capital efficient because of Uni V3. But we still, have this ability to mint more token to provide leverage. So I think that's the major change of of PERP V2. And of course, the benefit is that we get the concentrated liquidity straight from the Uni V3. So LP or maker, they can place gaming order right now. So we cannot do gaming order before. So definitely they can do gaming order. So they can concentrate liquidity. They can implement market making strategy like a traditional market maker. It will be but of course they are kind of like a detail that's different. So definitely that's the major benefit we get.
Okay, so I think you kind of brought up a lot of new concepts, and I think there's a lot of new concepts from Perpetual Protocol V1 and the Perpetual Protocol V2. But let me try to break it down a little bit, some of those concepts that you brought up. So the PERP Protocol V1 uses the constant product market maker, which is the X times Y equals K formula used by Uniswap V2 and also SushiSwap and so on. This is kind of the model, this is a bonding curve where liquidity providers contribute 50% for both tokens, for example, ETH and USDT, into a bonding curve, and then the price sort of move according to this bonding curve, right? But then you brought up this concept of a virtual AMM, a virtual automated market maker. So I guess before we dive deeper into all these other concepts, let's just get to the basics again. How does a virtual AMM work with respect to Perpetual Protocol V1 uses the virtual AMM, and how does this compare against the normal X times Y equals K constant product market maker on Uniswap? There is some difference in both, right?
Yeah, that's a good question. So PERP V1, I think, the virtual AMM is kind of our unique design. So like I said, we are actually using the same mechanism like Uniswap. So SYK, everyone, kind of know that. And the question is that because we are doing this perpetual contract, we need to provide leverage. And also the same thing that we talk about, we don't really have the underlying token. We are not really supplying ETH or supplying other token, like Uni token or 1inch token into the AMM. So we need to have this mechanism that mint virtual token. So that's the first part. We have this minting, and then we have to control the leverage. We have to make sure we liquidate, the trader at the right time. So that's one part. The second part about virtual AMM is that it's actually quite interesting that the virtual AMM design doesn't have counterparty. So in a traditional Uniswap like SYK model, there is counterparty. Counterparty is the liquidity provider. So liquidity provider provide liquidity to the system, and then they earn the fees. But at the same time, they have to implement loss because they kind of take the other side of the trade. But in PERP V1, that our virtual AMM, we don't really have liquidity provider. That's actually quite interesting because we found a characteristic on the SYK that we can actually take out. If everything we mint is virtual, we can actually we can control the supply of those tokens. We can actually take out the liquidity provider, and then kind of like get the virtual AM as a middleman. So traders kind of trade against themselves. So like Alice take a long position, and then like Bob take another long position once Alice withdraw, kind of like catch up. Actually, Bob will kind of become Alice counterparty. So I think that's how it designed. That's very unique, I think, in the space. So that's that. But scale, I mean, like it has like some issue or risk within this model. But that's how the V1 work.
So somebody must provide the initial liquidity to the system, right? So I guess in PERP V1 you accept USDC as your collateral, I suppose. Is that the correct way? So, and then once you put in collateral, you get the amount of money that you can sort of trade on PERP V1, and the amount of collateral that you put up sort of backs the entire solvency of the PERP V1 as well, right? And it's interesting because there is no, unlike centralized exchanges, you sort of, when you buy a contract, there must be a seller somewhere. So a winner, someone making a profit somewhere must mean someone making a loss, as it's a zero-sum game. How does it work for the PERP V1? So if let's say I make like a $1 million profit on the trade, that means the system as a whole has suffered $1 million loss. There is no counterparty, so the losses are socialized among all traders. Is there a possibility that like one trader make a supermassive gain and kind of bankrupt the entire PERP V1 system?
Yeah, that's a really good question. So the first thing is that there might be like one trader who wins a lot of money, but it will not bankrupt the whole system because mathematically it's kind of like a pool. So if you think about, think like this. So suppose that we have if we start when ETH is like $100, suppose that we create this AAM, and then so there are like 10 traders coming in, and then each one takes a long position. So because of this is XYK, so everyone takes a long position, the price actually goes up. So you can see that if there are 10 traders, so the price goes up like 10 times, and then if they all sell their position after, just by the same order, then the price actually go back to the original price. I think that's actually pretty easy to understand. But it kind of, this actually kind of like demonstrate the questions you asked. So the trader, the trader actually trade against each other. So people, I take a long position, the price goes up a little bit. If I close it right now, I actually have no profit. But if another person come in, and then he or she also takes a long position, then actually if I close my position now, I got some profit, and then the other guy actually take a loss. So it's actually constructed like that. So I think that's.
So I kind of see how the system works, because it's still, so you trade against the bonding curve and against the other traders. So if you come in later, you buy at a higher price. But this also means that the price that is available for a trader to buy or sell on Perpetual Protocol may not be exactly the exact spot market price on, say, on Binance or Coinbase, for example, right? Because of this virtual AMM feature. Am I right to say that?
Yes, you're right.
Okay.
But also, I think that's the same as like BMAX or FTX. Most of the perpetual market runs like this.
And so how does this change when it comes to PERP V2, right? So I know you kind of take the Uniswap V3 model, and then which has concentrated liquidity and change. So like now, if I would like to provide liquidity onto PERP V2, do I still put in only USDC, or do I have to kind of put in 2 tokens into the model and set the range where I would like to provide liquidity?
Yeah, that's a good question. So for V2, we are still using USDC. So you only put in USDC. So I think that's a major difference between the LP in Uniswap and Perpetual Protocol. So we take USDC, and the maker or the liquidity provider then can, make a decision that if they want to mint virtual ETH, virtual Uniswap, virtual Uni token, or virtual USDC. Like for example, I want to provide liquidity by like 100 USDC. So I can put in 100 USDC, and then I can make, make a decision that how much leverage I want to take. If I want to take a 5x, then I can mint, like 500 USDC or 500 USDC worth of the ETH, and then I have these virtual tokens, and then I can see which range I want to put on the ETH market on Perpetual Protocol.
So I guess the steps involved with V2 would be, the first step is deposit USDC into PERP, Perpetual V2, and then I have to decide like how much leverage I would like to take, and then mint the virtual USDC and virtual ETH, and then let's say I put in $100, $200, $100, I can mint at 5x leverage, 500 USDC and $500 worth of ETH, and then I can kind of take both of these virtual tokens and kind of add to the liquidity of PERP V2 at a certain range. Let's say like between 1,750 USDC per ETH up to 2,500 ETH, for example, and I can kind of set that range, I suppose.
Yes, yeah, 100%, yeah.
Cool. And so I've got an interesting question to you, right? So as a liquidity provider, like, do you think I would make more fees on Uni V3, or do you think I would make more fees, LP fees, on PERP V2? Yeah,
that's a really interesting question. So, okay, so if we take a look at the fees itself, so let's suppose that the ETH market, and then we have this ETH perpetual market, and then you are looking at the ETH USDC on Uni V3. The first thing is that Uni V3, you can pick the fee ratio. So like they have like 0.05%, 0.3%, and then 1%. So you can, let's say that we use the 0.3%. That's most commonly used one. So you provide liquidity there. On Perpetual Protocol, the first thing is that we charge 0.1% of the fees. So the fee are less. But because, we have leverage. So if you only look at the fee-wise, if you suppose like the trading volume, the liquidity on the platform are the same, then if you use more than 3x leverage, then you should get, if you use like 5x, then you should get more fees than Uniswap.
Assuming the volume is equal on both Uni and
everything is equal. Yeah. So that's if asking about fees, yes, we might generate more fees, but of course it comes it comes with the risk. So on Uniswap, there is impermanent loss risk. So it depends on the region that the liquidity you provide in the region. How wide that region is, or like that range is. You actually you suffer from impermanent loss. So you have to do a lot of calculation there. On us, we don't have impermanent loss because you only supply like USDC. You mean virtual ETH, right? So it kind of like doesn't have impermanent loss, but you do own long or short position. So if you put in like a VUSDC there, you kind of like want to take kind of like short position there. So if you want to provide liquidity on our platform, you have to, I think it's more like traditional market making. So you have to make sure the long and short position is kind of like balanced, in your account. So of course there are different strategy. There are lots of different strategy for the market maker. On like central exchange, but I think that knowledge can be brought up to Perpetual Protocol. But I think that's the risks you are facing are different.
The CoinGecko podcast is sponsored by eToro. Here's a short blurb about the services that eToro provide.
Meet Chris and Mark. They've both heard of Bitcoin and Ethereum. But while Chris is using eToro to trade top cryptocurrencies, Mark keeps getting cold feet. Chris uses eToro's simple and intuitive platform to build his own crypto portfolio. And Mark is still waiting for a sign. Chris follows and connects with other experienced traders on eToro. Mark is following the advice of Eugene, a friend who prefers to keep his money where he can see it. Chris uses eToro's copy trader to automatically replicate the portfolios of leading traders in real time, while Mark is still searching for answers. Do you feel like a Mark? Join eToro and gain the confidence you need to trade crypto. eToro. Sign up for free.
Yeah. I mean, I kind of miss the days when being a market maker in DeFi was so simple. You just take 2 tokens and just put into Uniswap V2 and just pray that you don't get hit badly by impermanent loss. But now with Uni V3 and then all these things, there's so many more strategies involved and so much more complexity involved when it comes to market making. You have to think about IL, impermanent loss is a complex topic by itself, but now you have all these other things that you have to worry about. So yeah. Talking about leverage, right? You mentioned how if you put 3x leverage, you can kind of get the same amount of fees on Uni V3. So assuming the volumes are the same, what is the maximum leverage that one can trade, can go long or can go short on PERP V2?
It's still 10x.
10x.
So we kind of capped the leverage on 10x. The reason behind this is that of course, the blockchain speed is kind of like an issue, that how fast we can react. But actually, the major reason that we are fixed as 10x for a long time is because the community doesn't want to increase. So we actually kind of like have a discussion within the community, within the Perpetual Protocol community, that we want to increase it to like 15x or like 20x. But actually, the community doesn't want that. They feel that people just got wrecked. I think that as a software provider, we were okay with like 10x, 20x, or like more. I think because of all these like new layer 2 solutions that that can really enable like very high like bandwidth for the trading protocol. So I think in theory, we should be able to get to like 50x or 100x is a little bit too more, but maybe at least at 50x. I think that should be fine. But it's more like 50x or 100x on like Binance actually is more like for marketing. Yep. You don't really want to use like 100x.
Yeah, I think it's irresponsible. I've been saying this for a long time. I think 100x leverage on any of these derivative platform is just, it's just asking users to get wrecked. No one in their right mind should be using 100x leverage. It's just, it becomes a casino actually. Like, its whole thing is casino. Like there's no, I find it irresponsible, like all these trading platforms offering 100x. So I'm curious to hear, right? Like, why do you think your community sort of chose to not offer 100x? It's kind of like the crypto trading statement, right? BitMEX offers 100x, and then everybody wants to kind of do a little bit more. FTX has 101x leverage. Binance Future has 125x leverage. Why did your community decide not to do like 20x or 15x? For example, like, do you think it's because I'm curious to hear like the reasons why they kind of decline it.
Yeah, I think that's a really good question. Actually, I'm kind of like puzzled when I see the discussion, because I thought this is actually an easy path. Like people want that more leverage, but actually it's not. I think the main reason is that the community is mostly by traders, people who really put in money, who trade, so they don't feel they need over maybe like 5x. That's what they have in their mind. So like Binance or like central exchange, or maybe me. We have we are more on the operator side. We are thinking we should provide more features to the users, but in the end, it's not the case. What they don't think this causing any issue. They think that getting the things they want to trade, this other like features are more important, like cost margin or other things, much important than like increase the leverage. So I think that's the difference. Yeah.
Let's talk about liquidation, right? One of the reasons why like BitMEX, Binance Futures, FTX kind of like offer this high leverage. One is marketing, but also they kind of make a lot of money when the user, when the trader gets wrecked and gets liquidated. Like, I mean, take a look at BitMEX insurance fund. I mean, it's called an insurance fund, supposedly to protect all the other users, but every time a trader gets liquidated, it gets wrecked, like the insurance fund goes big. And I think there's like over 130,000, 150,000 Bitcoin in the fund. Like, there's no reason why you really need to maintain such a huge insurance fund. And who really owns the insurance fund? I mean, it's owned by BitMEX, so it goes to their P&L at the bottom. So my question is, if a user gets wrecked, it gets liquidated. How does a user get liquidated on Perpetual Protocol? Maybe V1 or V2, it doesn't really matter. And what happens when a user gets liquidated? Do they, and does any of this remaining funds, for example, goes to the Perpetual token holder, for example, or there's none?
Yeah, that's a good question. So we are actually follow the same design as BitMEX and also FTX and Binance. So we do have this insurance fund. Okay, so every time, all the traders maintain a kind of a margin ratio. So if you want to do 10x, you have to make sure that, so our max leverage is 10x, but we do have a buffer. So the max you can go is like 16x, so 16. But once you go over that, we will start liquidate your position. We have partial liquidation, so we will take a 1/4. I mean, depends on situation. But for example, we take like 1/4 of your position, and then we will sell those positions at the market price. So if everything, if everything was well, which means that we liquidate the position at the right time. So there, because we sell the position, so we actually earn, they are like fees. So we took part of the fees as a penalty to the liquidation, and then put that fees into insurance fund, and the rest of the fee we actually give out to the liquidator. So there are people who run in bots, and then who are competing for the liquidation.
Mm-hmm.
So that's how it works now. And the insurance fund, just like you said, it's actually, the fee is actually put in the insurance fund, and then it's prepared for the future. Because like when the market really move like a lot, we might not able to liquidate, the trader's position in time.
Mm-hmm.
Like it's actually go straight down, and then we want to liquidate in the middle, but in the end, actually the price tanks. So at that time, we need to pay for the bad debt. So we use the insurance fund.
Mm-hmm.
But like you said, it seldom happen. So the insurance fund actually, is positive most of the time.
Mm-hmm.
Yeah.
So it's interesting, like how in crypto, this scam wicks happen really frequently. Like, it just scammed all the way down for like less than a minute or like 30 seconds, and then it's moved back up, or it just moved to the top. And it just kind of, on centralized platform, it just wipes up a lot, especially on BitMEX, Binance, it just wipes out. Because there's no partial liquidation on this platform, it just wipes out all these traders, even though like the price just touches the liquidation point for a fraction of a second.
Mm-hmm.
But when it comes to like decentralized platforms, like the liquidation engine is all not run by you guys, it's all run by liquidation bots and all, and then the price has maybe some delay from the oracles and all. Will traders be affected from these scam wicks going up or going down, and they get wiped out as well from partial liquidation, for example?
The first thing is that actually partial liquidation actually prevent this. A lot of time, you see, I personally don't think that the centralized exchange, make it like this. They just want to wipe out all the long or short. I personally don't think that, but it happens because I think the first thing, the market maker. So they are using this order book. So market maker, they can pull away their liquidity, anytime they want. So when things, when the market actually is, become more fluctuate, they just pull the liquidity. So you can see that quick dip. I think that's definitely the first thing. The second thing is that if you don't have partial liquidation, then you will have cascading liquidation happen. So once you liquidate one position, drop, it kind of it will take out part of the orders, and then the price drop, and then it drop again. So definitely, I think those are the reason. On decentralized platform, the first thing is that we are not really offer that I mean, the leverage offer is 10x. So, I mean, it's not really that sensitive that, when the price crash. I mean, for 10x, like I said, it's like 16x. So the price actually has to move. I mean, maybe, more than 10%, then you got liquidated. So, I mean, it's not really that, within an hour, you have to move move down 10%. I think that's really hard. So I think that's, on our platform, the leverage is less. The second thing is that we have partial liquidation definitely help. And we have this AAM. So I think at least for traders or liquidity providers, they pull away liquidity. I think that's really hard, especially we don't really have liquidity provider. So cool. Yeah, so it's kind of like we don't have that kind of wipeout. Happen in our platform. Yeah, but definitely still, if you take leverage, you will get liquidated. Yeah, sometimes.
It's a dangerous place to use leverage. I generally try to avoid because I've been wiped out too many times as well.
Yeah.
On PERP V1, you guys launched on Ethereum mainnet and you also deployed it on xDAI. But for PERP V2, you guys chose to deploy on Arbitrum and it's no longer on xDAI, I believe. So I believe it's also available so as a trader, you can kind of trade on the Ethereum mainnet or on Arbitrum. So I'm just curious to hear from your point of view, why do you guys choose xDAI for V1 and then Arbitrum for V2? And how do you end up with these two solutions instead of the other scaling solution? There's so many out there in the market.
Yes. Yeah. So we actually deployed on ETH mainnet, but we just pull away from there. So we actually don't really release it. The reason behind this is that so we actually, everything is ready last September. So we want to launch a protocol at that time. But at that time, the gas price, I remember, is 500. There's one day Uni release a token, it pump up to 1,000. So at that price, actually open position costs you 100 USD.
Oh, wow.
Which is impossible. Expensive. There's nowhere on the earth that any trader want to trade. Pay $100 to open a long position. So we deploy it. We found that it's not possible, and then we actually don't really launch it. So we just put it there, and then last September we just go out and then try to find layer 2 solution that we can deploy. So at the time, actually there are only two choices we have. So one is Matic, which is Polygon right now, which is really good, I think. And the other one is xDAI. We pick xDAI because we have one engineer who are more familiar with xDAI, and also xDAI have been running for more than a year. Last September. So you already been there for a while. And Matic, which are brand new, not really brand new. They have this POS new system coming out. That's really interesting. But at the time we just want maybe go for the safer bet. So we use xDAI at that time, and we actually do lots of engineering work, and then we launch everything last December. So we got probably 3 months to do everything. Yeah, and fast forward now, I think the xDAI actually is working quite well. The gas fee is really low, and I think the throughput is good. So we have been on there. We don't really have a major issue on there, but because the PERP V2, right now the whole system is depend on Uniswap V3. So we need to go to a place that the Uniswap will deploy. So Uniswap commit to deploy on Arbitrum and also Optimism. Yeah. So those are the places that we are going. We should target at.
You guys also work with Delphi Digital to redistribute the trading fees to PERP token holders. I saw that stage 1 has already been live and stage 2 is pending deployment. I guess when is stage 2 expected to launch, and what percentage of revenue from the trading fee that will flow to PERP token stakers?
Yeah, that's a good question. Actually, we kind of struggle and try to get a good answer. So before talking about this stage 1, stage 2, actually I want to explain that the virtual AAM, the risk. So there are 2 reasons that we want to build V2. One thing we talk about a lot is the capital efficiency.
Yep.
So we want to have like concentrated liquidity. One like liquidity provider can use that strategy they want. So that's definitely a really important thing to us. The second thing is that the insurance fund. So right now, I mean, so I believe we have like 3.5 million in the insurance fund right now. So
dollars, right?
I mean, it depends. So if you look at the chart, the insurance fund actually goes up and down. I mean, it really doesn't really have a pattern. The reason behind this is that, like we talk about the virtual AM. I mean, before that, the virtual AM is not a counterparty to the traders, so it doesn't have market risk. But it did participate in the funding payment. So funding payment is a mechanism that tries to maintain the perpetual contract aligned, kind of a pack to the underlying assets price. So we follow how FTX, decide their funding payment. So we do the funding payment per hour. So we take a look at the market price and also the index price. Find that difference, and then long has to be short or short has to be long.
Yep.
But on our platform, at any given time, we actually have unequal amount of short position and long position. So for example, we might have like 1,000 long position, but only like 900 short position. So at this time, the insurance fund will have like make up those like 100 short. So you will participate in the funding payment. So you might pay out or you might receive funding payment. That's how it works now. So I think if the market is kind of like stable right now, it doesn't really fluctuate a lot. Actually, I think the insurance fund can go up steadily. But once the market fluctuates a lot, it might have risk paying out. So that's actually the major reason that we want to have this new V2 design. We actually try lots of different ways to try to avoid this problem, but I think trying to combine with Uni V3 is the best solution we have. This risk I talk about, it doesn't really, it's not really, a big issue right now for the V1 protocol. But if you think that if its price actually shoots up to like 10x, then it will become problem. So we want to prevent that. Okay, so back to the question. So stage one, we actually try to redirect all the fees to insurance fund, and then try to make it, accumulate more at least. So we are in the step right now, and for step two, because we don't really have a good algorithm that predict the inflow and outflow of the insurance fund. So we will probably start with like smaller amount, maybe like 10% first, and then bumping up a little bit, like 10, 20%, 30%, and then see if the insurance fund can be maintained.
Yep.
So that's what our plan is.
Cool. What do you say would be, probably running up to the last question or so for today's podcast, but what do you think would be like some of the upcoming plans for Perpetual Protocol in the second half of the year?
Yeah, that's a good question. So definitely working on V2. I think that we've been working on this for some time, and then trying to implement So I think for V2, we talk about that we want to, swap out the XYK and then use Uni V3. That's definitely one thing. And then we also want to, implement other things like cross margin. So we don't have cross margin right now. I think cross margin is very important to us.
Cross margin, what's that?
So right now, Perpetual Protocol runs on isolated margin.
Okay.
Which means that if you want to, I want to trade ETH, so I will put in collateral, and then I calculate the margin ratio based on that market only. So if I earn money on ETH market, but I lost some money on the Uni market, the calculation is separated.
Okay.
So you still need to put in more collateral in the Uni market. But the cross margin is that you combine all the market together. Okay. So yeah.
It's calculated. So it's like isolated versus cross margin across all your positions in Perpetual. Okay.
Yes. Yeah. So we don't have that. Definitely want to have that. We want to like FTX, right now we only take USDC, but in the future we want to take other collateral, maybe ETH or like maybe other stable coin. So that's definitely something we want to do as well. So this more from the trader side. We want to have features on par with like centralized exchange like FTX. I think FTX has done a really great job. So we want to have the feature there as well. The other thing is that we have this like new feature that we want people. So right now, all the market on Perpetual Protocol, we run through the governance. So we create a vote, like we want to create the market for 1 inch token. So we will have a vote. But in V2, we also want to create this permissionless market creation. So like you can deposit, you deposit some, something in the insurance fund, also become the liquidity provider at certain level. Then you can create the market you want. So it's more like just a little bit complex than Uniswap. Create like on Uniswap you can create any market. But for us, because it's average, so someone need to provide something for insurance fund. But once that's passed, then anyone can create their market. So I think that's also a big milestone to us.
Cool. So I think I want to ask this question earlier, but I kind of forgotten. So do you think a decentralized derivative platforms like Perpetual Protocol and maybe some of your competitors as a whole, this category can compete and be better and have more trading volume compared to a centralized perpetual derivatives platform like BitMEX, Binance Futures, FTX? You've seen it like Uniswap, SushiSwap doing more volumes than Coinbase, for example, on certain days. But do you think this will also happen in the decentralized derivative sector?
Yes, I certainly believe that's actually why I'm working on this, right? Like maybe like 1 or 2 years ago, it's very hard, but with all the layer 2 solutions coming up, I think, so we have like this usability issue, we have this performance issue, we have like, mechanism issue. I think performance at least, I think it will be fixed in the near future. And the mechanism wise, actually, like I said, we, not only us, like other, like our competitors, they are working on different things. They try to bring the features on par with like centralized exchange. So I think that will be solved in the near future as well. So UX, I think it's still hard to kind of like, make sure your money is safe. You kind of like got your money on your own. I think that's still hard. That's not a quick fix. But I do believe that in the near future, there will be like, someone come out with like a better solution to, private key management or something like that. But, these 3 issues, I think we can definitely solve it. And it's more efficient than the centralized one, I believe. Yeah.
Cool. Yeah, I certainly hope, I'm a big proponent of DeFi. I certainly hope that everything decentralized will take over the centralized platform. So just like how we saw Uniswap and SushiSwap getting more trading volume over Coinbase, I certainly hope like decentralized derivatives will grow as well, and Perpetual and one of your other competitors, maybe hopefully Perpetual, I suppose, will kind of grow and beat the centralized providers. So yeah. I think that's that kinds of wrap up our time for today. Would I say thank you very much, Yenwen, for taking the time to answer my questions on Perpetual today, and it's very interesting to hear from you. Very insightful.
Yeah, thanks, Bobby, and thanks for inviting me. Yeah, I think that the DeFi definitely will go. I think it's kind of like goes down a little bit, but I do believe that with layer 2, I think Uniswap can get 10x of the trading volume in a year.
Cool stuff, man. Yeah, looking forward, and let's see how things go. Thank you very much.
Cool. Yeah, take care. Thanks.
The CoinGecko podcast is sponsored by eToro. Here's a short blurb about the services that eToro provide.
Meet Chris and Mark. They've both heard of Bitcoin and Ethereum. But while Chris is using eToro to trade top cryptocurrencies, Mark keeps getting cold feet. Chris uses eToro's simple and intuitive platform to build his own crypto portfolio. and Mark is still waiting for a sign. Chris follows and connects with other experienced traders on eToro. Mark is following the advice of Eugene, a friend who prefers to keep his money where he can see it. Chris uses eToro's copy trader to automatically replicate the portfolios of leading traders in real time, while Mark is still searching for answers. Do you feel like a Mark? Join eToro and gain the confidence you need to trade crypto. eToro. Sign up for free.
This podcast is provided as part of the overall information on cryptocurrency contained on our website, is for your general information only, and does not howsoever constitute any endorsement, financial or investment advice, nor any solicitation or offer of securities or other financial instruments. CoinGecko and the podcast presenter makes no warranties, implied or express, of any kind in relation to this podcast, including, without limitation, the accuracy and updatedness of its content. All opinions and recommendations there in the podcast are based on the personal opinion of the presenter. Please conduct your own research and procure professional advice should you, at your own risk, decide to howsoever invest or trade in relation to the content contained in the podcast.
For the latest crypto prices, visit our website. If you haven't already, make sure to subscribe to our YouTube channel to keep up to date on the latest crypto trends.